Let's go.
To be honest, we've got some Georgia Tech students, PhD and master's students. We have some folks who are essentially maybe executing the design of, really for municipalities, but is that a fair assumption? Is that a fair summary?
Working alongside like multiple design teams, general contractors,
Perfect.
we're part of the team.
You're part of the team. Building the software or actually executing the design?
On both sides.
Okay, great. And I guess from the rest of the group, maybe a show of hands of who's kind of building software that's supporting the construction CAE industry? Maybe over there? Okay, great. So I think this will be applicable. And I just think maybe starting out with the R&D credit. Is anyone in the room not familiar with the R&D tax credit? Great. So we'll go in and do a little background on that. So the R&D tax credit, very sort of powerful and lucrative credit designed for companies who are investing in developing new products and new processes. I guess Congress passed this in the early 80s, really with a goal to incentivize companies to go out and invest, try new things, and the mechanism for the incentive is through cash savings. Now, for the longest time, the challenge with the R&D tax credit is for the companies that needed it most, startup companies, tech companies, they weren't really able to use it because the R&D tax credit only offset income tax. So if you were in a situation in startup mode and you're not yet taxable, the R&D tax credit wouldn't translate to current cash savings. That, however, changed in 2016. You can now use the R&D tax credit to offset payroll taxes. So in general, the R&D credit should be applicable if you're in startup mode, if you have employees, whether you're profitable or not. And then, of course, it's very applicable for, let's say, larger, more developed companies who are paying tax, which may be your customer base. So maybe the goal and objective of today's conversation really is to talk about where it applies to this, I guess, this group of people. And it really comes in a twofold. So one is, can your company claim the R&D credit for yourselves? And then two is, if you can't get the benefit through that mechanism, can your customers benefit from it? And could you leverage that to either reduce or get better pricing or increase your sales? Does that make sense from a summary? Does that fit kind of everybody's objective? Small group, so I encourage everyone to talk. Specifically with the industry that most of the audience is serving, architectural, engineering, construction, there's a big misnomer out there where a lot of your client base, if they are in that space, may not be aware that they're eligible for the R&D credit. So you could essentially bring value to your customer if they're not currently taking advantage of it. It's likely that they are, and then you could say that the services that you're offering or your product could help increase and generate additional benefit in that space. So we're going to talk a little bit about kind of do some myth busting as to how architectural, engineering, construction companies can qualify for the R&D credit, just so you have that basic understanding as you're talking to your clients in that space. We'll then get into how do you specifically leverage, if you can't, I guess, generate benefit from the R&D credit for yourself, how do you leverage that in conversations with your clients? And I would encourage this to be a dialogue. This isn't something that I normally talk to my clients with. I do think that it could be, there could be an angle there that you could take. And then finally, we can get into specifically how can you take advantage of the R&D credit for yourself or your own company. And that may be where we want to start. I guess really not sure. Maybe a show of hands. Show of hands from the audience. Who thinks that if they did generate an R&D credit, that they have income tax to offset for their company, or that they're paying employees and could offset payroll tax? Okay, so that's actually, let's just jump straight into that, because I think first and foremost, if that is something that you can take advantage of, that's the lowest of the hanging fruit, and it should apply to everyone. And then I think we can get into a little bit of how this applies to your client base. So if you are out really developing any new product or process, in the software space, it's pretty low-hanging fruit. Question?
Why software?
Doesn't have to be software. You could be doing design work alongside with your clients. You could be any product. The assumption was the audience was in software. But great question. Do you have a specific example?
Or developing robotics and IoT, so.
Absolutely. I've got clients that are developing purses and handbags that claim the R&D credit. I think that would apply. But again, thinking this was kind of a SaaS-based audience, I've listed activities that are primarily around software development. But really, it comes down to if you're developing new products, improving upon existing products, and that's to you, not to the world. Developing new processes, improving upon existing processes, and those activities or those products are not even those products, but the effort is technical in nature, meaning involving the hard sciences, either computer science, physical sciences, engineering, and you have uncertainties around, like, can you do it, how can you do it, or what's the best design for doing it, which is a pretty low bar, then you're likely going to qualify.
How would you, is it qualified or qualified? How do you qualify in the numbers? How do you show that to the IRS that it's credible?
That's what I do every day. So, and I can kind of walk you through that process, but generally there's a 4-part test, and I just went through that. It's developing new approved product or process, having technical uncertainty at the outset.
I understand that concept what you said, but when you go to IRS, you probably have paperwork and you get deductions.
Correct.
What paperwork does you send out?
You provide a 2-page form. If you are audited, that's a big if, then you have to go in and demonstrate how your activities meet the criteria. So what our firm does, what I do on a day-to-day basis, is help clients navigate that IRS audit process so that if you did get a $100,000, $200,000, $1 million credit, you sustain that credit.
What form would that be under?
6765 is the form that it's claimed on.
67.
65.
If you're doing consulting and you're doing this activity, but the product at the end of the day belongs to your client,
Great question.
their R&D credit or yours?
We actually get to that in this topic right here. Let me get back to that later, but we could definitely get to it. But in general, I guess, if you're doing that, developing new products or processes, if you're incurring these kind of costs, so you've got employees, or let's say time spent by the owners of the company, and then maybe in a partner role. If you're paying employees and incurring time yourself towards that effort, then you're incurring wage costs, and that could be the actual execution of the R&D yourself. It could be support of that or supervision, so a level above and a level below. If you're incurring supply costs, maybe you're buying robotics and spending a lot of money to go and test, is this going to meet our needs? Those costs can go towards it, as well as if you're paying an outside contractor to do the services that would otherwise qualify if they're an employee. Those are the 3 types of costs that we can claim. Question?
So on the outside services side, contract developers also qualify. If we have an expense related to contract developers, that would also qualify.
Correct. There's some nuances to it. For the same reason, if you're doing work as a contractor, at the end of the day, the person who is at risk for those costs and it retains rights to the technology that's being developed, those are the people that can claim this cost. So if you're paying, let's say, a contractor on a time and materials basis and you own all the intellectual property rights, then you get the credit. And intellectual property rights are very low. You really just have to have some level of ability to use it without having to pay for it. Question?
If you have any costs that are specific to an R&D effort that are not valid for deduction, is there anything that isn't, as long as it's specific to R&D?
So there's a couple things. One is, if it's going to go towards the credit itself, it needs to be in these 3 buckets. So the credit's very specific. However, then you've got an R&D deduction, which is much more broad and is going to be pretty inclusive of any cost that would be incurred.
Well, those are pretty big buckets.
Right. But another example of R&D cost that could be incurred would be if you bought a piece of equipment and you placed it in service and capitalize it. That cannot go, and you're using the R&D function. That doesn't go towards the R&D credit, but you can deduct the depreciation on that equipment as 174 R&D costs.
Is there a carry forward opportunity if you're
20 years. So if you can't use all of it, you can carry for 20, back 1 year, forward 20. One thing too, the state of Georgia and a lot of states have R&D credits, and the state of Georgia is refundable against payroll taxes in Georgia as well.
So, I've heard that the credit is for an increase in R&D, or is it just for all R&D, or which?
Great question. So it's called the credit for increasing research and development activities. And the more you spend over prior years, the better your credit is. But if you are flatline spending, your credit's going to be roughly 7%. If you're spending incrementally, it's going to be more. If you've decreased substantially, it could go to 0. And the reason why, the computation itself is you look at the 3 prior years, you take the average of those 3 prior years, you cut the average in half. If you spent over that half the average, you're going to be in credit territory. But 7% if you're flatline is the baseline. Plus state credits on top of that usually range between 3 and 5%. Great questions. Going the wrong way. So utilization, if you are in startup mode, you're not yet paying a lot of income tax, then the main sort of ability to sort of utilize this is through the payroll offset. So if you're paying your employees, as an employer, you're taking out 6.8% and paying that towards the government for this FICA, Medicare, that sort of thing. So you look at that, how much you pay over the course of the year, you can offset that through the R&D credit up to $250,000. Could be a nice influx of cash, where otherwise, historically you wouldn't be able to utilize it. State of Georgia offers the same thing. You can offset, payroll taxes for the state of Georgia. Of course, you can offset the income tax, and then if you're under $50 million, you can offset AMT. So those are your methods for translating the credit to cash savings. Again, kind of going back, you've kind of got, for this audience, we've got two groups. We've got, two angles here. One is, can you use it yourself? There is, if your client, if you can't necessarily use it, how can your client do it? And then how can you maybe leverage that to either get a better deal on pricing, or potentially take the cost that you're doing for your client, the contract work, towards the credit, which would be another angle. So let's talk now. We've kind of covered how this applies to tech companies, startups, and how you can utilize it. It's pretty straightforward for you guys. It's a little bit less straightforward for your customers who are in the architectural, engineering, construction. Let's talk a little bit about that. So again, there's a big misnomer. A lot of people don't think that construction companies can qualify for the credit, but they can. Here's a few case study examples. I've worked with a $500 million general contractor. We just went through that, claimed them $2.5 million of federal credits in 1 year. So really powerful, really big numbers. A $500 million manufacturer is not going to get that kind of credit. So this is kind of an isolated instance, but the right fact pattern, you can really generate a significant benefit. Worked with other, a $250 million precast contractor. You wouldn't expect them to have a lot. They're generating credits, $750,000. But you can see here that there are a lot of credits available in the AEC industry. So to explain a little bit how that works, think about the life cycle of construction. You start with feasibility analysis, get into conceptual design, then you do estimating, project management, then you actually construct the execution. These first few stages have tons of research and development. You're exploring different designs. You're looking at what's the best means and methods, and then maybe compare that to manufacturing, because people understand how manufacturers qualify for R&D. People don't always understand how construction. But you think you maybe doing some market research early on to figure out what the need is. You go into product design, process design. Well, these 3 areas are clearly where R&D is. And people get that for manufacturing. What they don't get it is, how does that apply to construction? Well, it does. Any questions there? So how? So what specific activities within construction qualify? It sounds a lot like what you guys do. It's really the design phase. Going back to, what are those tests that you have to meet? First test is, are you developing a new or improved product or process? Well, almost every construction job, unless it's a pure duplication, is a new product for that construction company. It's a product of one. You build one prototype and you're done. So if that's your goal, the second test, do you have technical uncertainties around can we build this product? What's the best methodology, so means and methods? Or what's the optimal design of this product? So then I think you pretty clearly have technical uncertainties. We check test 2 off. Test 3 is, did we go through a process of experimentation to eliminate those uncertainties? So utilizing BIM modeling to evaluate different designs or exploring different design functions, that is a process of experimentation. And this is where it applies to what you guys do and the technology that you're building and the services that you're offering. So really when we're talking to construction companies, we're digging into the work that they're doing in the design phase to explore different designs because that's where the R&D occurs, as well as exploring different means and methods. Here are a few examples.
People actually get away with, I mean,
Get away.
it actually works as an R&D.
So $750,000 credit, went through an IRS audit, no change. Now, if I go through IRS audits, I was just talking to the IRS right before this presentation. This happens all the time. The IRS, they don't always like construction companies claiming it. So it's going to be more of an uphill battle as compared to, let's say, manufacturing or tech. However, whether it was congressional intent or not, the fact pattern of construction companies fits in very well with the way the law is written now, and they don't really have a lot of leg to stand on to challenge it. Now, if you get aggressive and start claiming, now everything that we're talking about here is in the product design phase. You're trying to design the ultimate solution. If you start getting into the production phase, which is the execution of the construction, that's where it gets a lot more gray and ambiguous. Are you really working to eliminate uncertainty, or are you going through production? But there's countless examples of going through IRS audits, construction companies claiming credits, and successfully getting through those IRS audits and sustaining the credits that were claimed.
Would that apply also to like training people how to use BIM and things like that?
It does not. Training is not included. So that's one of the challenges with, I think, the angle we're trying to say, how do we sort of leverage the services that you guys are doing to gain more customers? One of the challenges is it's the use of the technology that qualifies, not necessarily the purchase. So if you're going in and customizing it heavily for your client, that could qualify. The client using it could qualify, but if they're just purchasing a subscription or purchasing off-the-shelf software, those specific costs do not. So I'm curious if you guys have. Sorry.
I know you say qualified a lot of times, but for the construction companies, but is this a corporation like S Corp, C Corp, or is it only everybody's involved?
Great question. So everyone can claim it. If you're an S Corp or partnership, what happens is you claim a credit because those two entities don't pay tax. The income and tax liability goes to the shareholders or partners.
Yeah.
So the tax credit would pass on just like the income does to the shareholders and partners. As a C corporation, the C Corp pays the tax, so the C Corp, the credit would stay there until it's be able to use to offset income
S
tax.
Corp is the shareholders taking from their income back into the S Corp.
That's correct. Now, one important piece, though, let's say the S Corp that generated the credit is not yet profitable, is incurring losses, but the individual shareholder has got income from other sources and paying a lot of tax elsewhere. You can't use the R&D credit from the business you can't use that credit to offset other income. It can only offset income created from the business.
Okay.
Make sense?
Yeah.
A feel for the level at which this is used. So do you have any kind of barometer, company of a certain size revenue, how much in the AEC space, how much the companies are typically getting back? Is there any benchmarks around that?
Yeah, I think probably the best. So in the AEC space, you're talking about serving the AEC space or in this space?
No, in this space.
So
AEC companies.
Right. And we've had the most success with construction companies and engineering. Architecture, because of their contract types, which I'll get into a little later, most of them, for the most part, they're not set up for them to take on risk. So that has been a bit of a challenge. But in the construction space, here's some examples. Now, these are the best scenarios, right? There's plenty that we're working with that are the same size that aren't generating the same level of credits. But these should give you an idea. I mean, I think if you're in the $50 million and up space and you're in construction and you're utilizing BIM modeling and utilizing like different sort of design alternatives, you're going to have some level of a credit.
We do, and we're taking advantage of some of it. Okay, so we're doing it, but I think we're leaving a lot on the table. So I'm looking for some benchmarks to see how much room I have to push. And I mean, get our own people to understand that a lot of the things we're doing, we're not taking credit for, and we're leaving it on the table.
Right. I'd say, in general, because the because the credit is not really driven based on revenue, it's driven based on the costs that are eligible. So I'd say the key areas to look at are your employee costs, because that's going to be the driver for a construction firm. So employee costs, specifically those that are going to be engineers, project managers.
Yep, got it. And in fact, when you hit those, we're right in line with those. I think one of the challenges is, how do you segregate when they're doing that work? How do you account for it and segregate those costs out as being eligible for the tax credit? And otherwise, it comes down to some type of estimation at year-end at tax time.
That's pretty much where most companies are. A lot of let's see, the companies that have been most successful have used, I guess, phases,
Yeah.
and said this phase was more of a, I guess, evaluating different design phase.
Yeah.
We're not there yet. This phase was more execution of the construction. That's been one way to do it. What I'd say in my experience is, I've worked with a lot of companies that have tried to implement a system to track solely for purposes of the R&D credit. That fails like 9 out of 10 times unless you've got strong sponsorship and buy-in from the owners or the leadership of the firm. And the reason why is because if it doesn't have an alternative business use, the likelihood of them actually maintaining it just for the R&D credit is not very high. What I would recommend is, if there is another business use, to maybe tweak that to capture the information needed. So like, let's say you could use the phases in your job accounting for business use, for better planning, and that's going to be used. So if you can incorporate that, but maybe tweak it to say, is this phase, or can we label our phases to align a little bit better with the R&D credit? That's probably where you're going to have the most success in implementing a system to track time. Now, all that said, you mentioned using estimates, and most of our clients in the construction space are ultimately estimating the portion of their time that's qualified. Am I running up on time? 4 minutes? Okay.
Just get rolling.
Yeah, we're just getting started. This is better than, I was the only person sitting here at 11:15, so I was a little worried. I actually sat down to look like a participant so that other people would come in. But so, we've been bouncing around a lot, and I apologize for that. Somebody asked a question earlier, which I think this is pretty important for, and part of the issue too is we've got two different groups of people. Somebody mentioned earlier about doing work for, or contract research, where you're doing work for someone else. And what it comes down to is, if you are doing work that sort of meets these criteria, and you're doing it under a contract, or you're paying someone else, those are credit eligible costs. The question is who gets the credit, because you've got two parties involved. So there are two things at play here. We call this funded research. There are two things at play. One is financial risk. So if you can demonstrate that you have financial risk for the work that you're doing, meaning that your payment is contingent upon success, that's typically going to be demonstrated in a firm fixed price contract. So if you are the contractor and are getting paid on a firm fixed price basis, the assumption is that you are at risk for those costs. If you're the contracting party and you're contracting out someone else and paying them on a firm fixed price basis, they're likely at risk and you would not be able to take those costs. If you're a contracting party and paying them on a time and materials basis, it's generally assumed that you're at risk. So while you can't rely on the contract type exclusively, that's generally a good rule of thumb of where you would fall in terms of financial risk. And with financial risk, it's either one or the other. You're not really going to be able to play both sides generally. We've seen that before, but it's kind of difficult to say both parties are at risk. The other element is substantial rights. This is a much lower threshold to meet. Generally when we say substantial rights, people think, oh, I need to have exclusive intellectual property rights to what's being developed. Not the case at all. The other party on the contract could have unlimited rights to the data, as long as the contract doesn't say that you have to pay to utilize the technology, or you get nothing from that. And there's so many options to get out of like bad intellectual property rights language. You could say that your client owns all of the data and the deliverable. That doesn't preclude you from being able to take or being able to utilize what was learned through the process. So there's different ways. So maybe the takeaway here is financial risk is pretty strict. Think back to firm fixed price and time and materials in terms of who's at risk. Substantial rights is a pretty low threshold to meet that. The IRS generally are not willing to fight that as much as they will the financial risk. Questions on that?
I have a different question. So I know that there are firms that have gotten audited and had to pay back all the R&D credits. What documentation is necessary to ensure that it's well documented?
Great question. So to speak to that a little bit too, I guess in the last 2 years I've been through roughly 40 plus IRS and state audits. Only have one that had adjusted, and on that one we were expecting an adjustment. So if you do it, if you document it the right way, you follow the procedures, you can sustain it. There are going to be situations too where you're claiming a credit in an area that's gray, and you should fully, I set an alarm so that I wouldn't go over. There are going to be gray areas, and you might go into it saying, well, the IRS is going to disagree with this conclusion, but they're also incorrect in assuming that my position is wrong. The tax law doesn't cover every single fact pattern. So in that situation, what we do is encourage our clients, let's think through and let's fully understand the risk and go in and say, okay, well, we've got a position, the IRS has a position, we're probably going to land somewhere between where we are and where they are. And that's generally what happens. You'll go through the IRS audit, it may be fully disallowed, but in appeals, it's generally going to be split in some way, shape, or form, depending on the strength of the argument on both sides. But again, kind of in our fact pattern, we're building out the documentation that's needed to sustain the credits through an IRS audit, and we try to resolve it at the field level rather than going to appeals. And I'd say to get, what we've done is there is, we developed our practice working with the IRS here in Atlanta 10 years ago to essentially say, what do you need in terms of documentation? They want to see 4-part test documentation, what we just talked about, how each project meets those. They want to see project nexus, meaning that, okay, you've got this big bucket of costs that you're claiming. Well, and you've got project X, Y, Z, but there's no connection between the two. They want to see the specific costs associated with project X, the specific costs associated with project Y, and the specific costs associated with project Z. And the reason why is if they agree X and Y are qualified but Z is non-qualified, they want to know how much to disqualify. So that's another thing, is project accounting, showing how each project meets those 4-part test criteria, and then also addressing your contractual risk issues. Those are going to be the main areas. Now there's a laundry list of other things. There's something you can Google, mandatory IDR for R&D tax credit. You'll see a list of 18 questions that they ask to initiate an IRS audit, and that's what we build our documentation around that. That's generally what they start with.
That second bullet up there says if another taxpayer pays or reimburses the taxpayer, does that mean it can't be used for public works? So we're doing design for public highways and bridges, that kind of thing?
So you think about every job that a contractor has, they're generally going to get paid for. So where we found is, so the fact that you're getting paid, it puts you in this funded research, but the question is, are you at risk for those costs? So if you're doing design work for that job and you're getting paid on a firm fixed price basis, or only going to get paid if you actually deliver a successful design, then you're at risk, you can claim those costs. Okay. If you're getting paid on a time and materials, and they're not really paying for a functioning deliverable, they're paying for your time, yeah, that's when you would not be at risk and you would not be able to take those costs.
Got it.
I think I'm at the end of the session, but I'll be around and be happy to chat through any specific questions. Yeah, I do. Got a lot. Thank you everyone for your time, and again, I'll be around if anyone has questions.